Saturday, March 9th, 2019, Maneco 64, home of alternative economics and contrarian views. Today I want to talk about the gold-silver ratio and why we need to see silver outperform gold before we break out of this 3-4 year consolidation we've had in gold, before we break up above 1375 or 1400. And I'll look at the technical picture of the gold-silver ratio and what it has been doing and what it has done in the past and why it's so important that we see silver outperform gold in terms of ounces of gold, of course. I'll touch upon as well, before I look at that, on the jobs data yesterday. In my video, which was done, of course, before the jobs data, I spoke about that it was going to come out and how the market could react. The numbers were kind of mixed. You had unemployment rate, which is really a number, a headline that's pretty good for the administration. It dropped from 4% to 3.8%. You can definitely say, wow, we've got the lowest unemployment rate in 50, 60 years, and that's technically true. But the markets themselves, they look more, the market professionals, the traders, investors, they look more at the non-farm payroll, and that, of course, was a huge disappointment. It only rose by 20,000. It was expected to increase by 181,000. And for those of you who don't know, the BLS, the way they calculate these non-farm payrolls is through a household survey. So they do a survey and they extrapolate how many jobs were created. It's not like they call all the major companies or keep track through the Chamber of Commerce how many people have hired, how many people have been fired. So it's just a survey anyway. So that wasn't good, and that's why the market at first reacted negatively. Yeah, the stock market did rally towards the end of the day, and it finished nominally lower, but it wasn't a great week, of course. So what about the other components of the jobs data? Well, average hourly earnings, that was up 0.4%. So that was higher than the 0.3% that was expected. As I said, the mainstream economic class, the Keynesian PhD economists, the Wall Street, City of London economists, the central banking establishment, they see that as inflationary, even though it's a consequence of the inflation that they create, the banking system. They've twisted things around. So bankers and politicians, like in the UK, they got a pay rise recently, the MPs, of 3%. Their inflation is running below 2%, but they get a 3% rise. But I would say that also, bankers, they get their bonuses, huge bonuses. Politicians, as I said, increase their salaries or wages, and that's okay. But when the average person is earning more, they say, oh, it's your fault, you're creating inflation, which is a complete rubbish. We also have the Fed meeting on March 20th. It's a 2-day meeting. It starts on the 19th. So will be interesting. I don't think they'll do anything then. They won't hike again. They won't cut, certainly, in my opinion. So that was the number yesterday, so not good. Of course, there's a note saying that says a month's number doesn't make a trend, so we need to wait and see for next month's data, not only jobs, but all the other parts of the economy. But right now, it's definitely not looking great, not only in the US, but other parts of the world, Europe, Asia. Gold-silver ratio. So basically, the gold-silver ratio, you take the price of gold in dollars divided by the price of silver in dollars, and you get the price of gold in silver. So the higher that is, the more expensive it is to buy gold, the better the gold price is doing in terms of silver. And historically, going back to the late 70s, early 80s bull market, until more recently until 2016, when precious metals have a very good bullish run, silver outperforms and that ratio goes down. I think that until we see that, unfortunately, I think the price of gold and silver are not going to be moving exponentially higher or breaking out. Does that mean that I'm not continuing to try to accumulate precious metals, physical? No, it's basically insurance, and you shouldn't worry about the price of the insurance. It's something that you need to have, especially because I think the next crisis we're going to have is going to be more of a currency crisis, a dollar crisis, and that's when you will need precious metals the most, in my opinion. That's why I recommend physical gold and silver. Of course, if you're in the UK or even in Europe, you can use my maneco 64 promo code with goldinvestments.co.uk. They're arguably one of the oldest bullion dealers in the city of London. You get a 0.5% discount when you buy gold and silver from them, and use the promo code. So let's look at the gold silver ratio then. First of all, I want to show you a monthly chart going back well to 1991. So and I'll take look at the tops and and the lows of this ratio. You can see here in 2003 it was quite elevated at around 80. Gold at the time I think was trading below 400, around 300 to 400. And then you can see that it started moving lower, went up, and then it came down in the beginning of 2008 there towards just below 50, around 49. So that was the all-time high at the time of gold, 1,031 thereabouts. Silver rallied as well, of course. I think the high there was 21 in silver. So not, it didn't make a new all-time high like gold, because the all-time high had been in 1980, around $50. And then you can see that at the heights of the crisis, when gold dropped from 1,000 to around 700, that ratio went up. That means that gold outperformed silver, and the precious metals market were going down. It traded back up to almost 80 again. And then the big move we saw, because that correction in that crisis didn't last very long at all. So if you'd gotten out at the heights of the crisis out of gold saying, oh, I'm going to buy it back, you might not have been able to buy it back. And I remember at the time, the premiums to buying real physical gold, coins and bars was very high. So you couldn't really buy it for 700. You'd have to buy it for 800. And that's why I don't recommend trading your physical gold. As I said, it's insurance. So we can see here that from that level, from 80 all the way down to 30. Yeah, it went down to 32 here. That was when silver went up all the way to $50. I mean, I think the low, post-crisis low was 9. So it went from 21 to 9, and then from 9 to 50. And silver topped before gold, because gold topped in, I think, September 2011 at around 1920. So there you go. Another example of how when you get a great bull run into precious metals, you do need that silver outperformance. So since 2011, as we can see here, there hasn't really been a big trend lower, except for 2016, which was just after gold and silver bottom in December of 2015, and we saw that ratio again. This time it was a little higher, around 83, and it dropped all the way to 60, around 66. And that was back in the summer of 2016 when gold went to 1375. I think the high in silver was around 21 as well. I'm not too sure, maybe a bit higher. And ever since then, the trend has been higher, and that's why we haven't been able to get out of the range trading that we've had really for more than 5 years, 5 or 6 years, which has been frustrating, of course. We have seen the market trade higher since the bottom in 2015, December, but there's been a lot of false starts. Let's look at the daily chart of the gold-silver ratio, and you can see here that maybe looking in hindsight, the fact that this ratio hadn't dropped when gold was doing fairly well towards the end of February, got up to around just below 1350. I guess that wasn't a good sign because silver wasn't outperforming, and maybe that's why we saw the correction in the precious metals lower. But yesterday, silver outperformed, as you can see here, with that big drop. And to me, it looks like this could be another one of those a big head and shoulder formation, even though we've had those before in the gold-silver ratio and they failed. So again, that 80 level seems to be really important. So until we see that ratio continuing lower and trending lower, and that would mean outperformance in silver, the price of precious metals are probably going to stay pretty much under control. So at least it gives people time to protect themselves with monetary insurance, which is physical gold and silver. What about the stock market? Just a quick look at the S&P. I did a video earlier last week, or this week, it's still Saturday, about the head and shoulder. And yes, it looks like we could be forming that right hand shoulder. When I did the video, it didn't look as clear, but we've had a down week. So does that mean it's going to go straight down from here? No, we could have a up week next week, and it stays below the recent top around 28.20, and then it go down the next week. These things are never like in a straight line, but it's looking more probable, the head and shoulder. Gold-silver ratio, we need to keep a close eye on that. Yesterday was encouraging. Silver outperformed, but we need to see continued outperformance by silver to see gold blow through that 1375 level. When that will happen is difficult to say, but I think we're closer and closer. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great weekend. Take care. Bye.